Hi, everyone. My name is Mark Henry. I'm a partner at Citrin Cooperman and co-leader of our firm's manufacturing and distribution practice. Today, we're going to be diving into the key implications of the One Big Beautiful Bill Act that was passed on July 4th this year. This bill has created significant opportunities for the manufacturing and distribution industries, and our panelists are here today to walk you through how it can impact you. What I will say about this bill is it's created an enormous amount of optimism in the industry, and I think that's been really helpful as we have tax planning meetings with our clients and we're trying to guide them through cash flow projections and growth in the next year. Joining me today is John Giordano, partner, co-leader of Citrin Cooperman's manufacturing and distribution practice. You'll see he's going to be available for questions and answers. So if you have questions as we go, please drop them in the chat. John will be fielding those questions, and after we get through our presentations, our panelists will be available to answer those questions. Our panel of tax professionals include Bob Alperin, who's a partner and leader of the firm's federal credits and incentives practice. He's over 30 years of tax experience, including 20 years of specialization in R&D credit studies, which you'll see as part of this bill is a huge component. Lucy Lee is a partner in Citrin Cooperman's National Tax Office in the firm's private client services practice. She has over 24 years of experience advising clients on sophisticated tax matters. And Eugene Revere is a partner and co-leader of the firm's state and local tax practice. He specializes in state and local tax and has provided state income tax review services to both publicly and privately held businesses. To cover some of the highlights of today, what we're going to walk through, Eugene, Bob, and Lucy will discuss tax strategies for manufacturing and distribution companies, highlighting the following areas: state and local tax, research and development credit opportunities in Section 174 specifically, and qualified small business stock, QSBS, if those of you that know it, and estate tax. As we go through, please, again, just a reminder, drop your questions into the Q&A box. John will be fielding those. If it makes sense to answer those directly as we're going through, we will do that as well. One thing you'll see at the bottom of your screen, and right on this screen, is our year-end guide. Just went live today, so hot off the press. There's a button at the bottom of your toolbar to download a copy and dig through that as we go through. Now, moving into Eugene, I want to hand it off to you to talk about state and local tax strategies.
Okay, thanks so much, Mark. So my session is going to cover both the OBBBA and the state ramifications of the federal changes, and then also a couple of topics on the state tax side. So starting off with the OBBBA, there's a piece, and I don't want to get too deep into the mechanics of state and local taxes, but the key consideration here is how a state reacts to the OBBBA. And there are a couple different ways that states follow the mechanics. And part of it is some states will say, we're going to use rolling conformity. And that just means that the state will kind of move in lockstep with the Internal Revenue Code. So if they have rolling conformity and there are federal tax law changes, the state will follow along with those changes unless there are certain modifications taken by the states. A static conformity state just means that as of a given date, the state adopts the Internal Revenue Code. California just changed their law. They now adopts the Internal Revenue Code as of January 1st, 2025. So the changes that we see here at the federal level don't automatically trickle down for California purposes. But then there are twists that states can take. They can say, okay, well, I'm a rolling conformity state, but I really don't like the idea of a certain provision in a federal tax law change. So we're going to decouple from that law change. So states can kind of mix and match what they prefer to do depending upon budgetary impacts and how they want to impact the tax liabilities at the state level. One provision that we saw come out of the OBBBA, which I really have a hard time saying, is this elective depreciation allowance under IRC section 168N. And the states, again, are reacting to that differently. Most states, however, decouple from the depreciation provisions at the federal level. So what we want to watch out for here are scenarios where folks get really excited about the federal impact, but they don't consider the state implications. So while you may create a great deduction from the federal perspective, many states will require that deduction to be added back. And you could have a scenario where you have a large loss from a federal perspective, and then when you move down to your state tax returns, there could be taxable income. And we get this kind of shocking point where there could be a tax liability that just kind of crops up unexpectedly. And that's why we want to be mindful of not only the federal law changes and the impacts to companies, but to map out all those state changes and work through all the different implications at the state level so you don't get any of those surprises. You'll hear Bob talk a little bit more next about the R&E expenditure changes at the federal level related to this tax law change. But I just wanted to call out there are, again, considerations at the state level, that some states will conform to those changes at the federal level, others will decouple and do their own thing. And we also want to stay mindful of the fact that there are R&E credit opportunities at the state level. Some kind of piggyback the calculation at the federal level. Some states kind of go off on their own tangent and do their own calculation. Some states don't have an R&E credit, but we really want to be mindful to that, those specifics on the state side. There's a little bit of alphabet soup in the next bullet about how at the federal level, foreign income is treated in many cases in a beneficial way. Again, states kind of do their own thing here. Some of them adopt the federal provisions, and they will from an OBBBA perspective. Others are going to take their own course. That's still evolving, right? This is pretty new law. Things are changing with 2026, and states are trying to figure out what they want to do here. So there'll be a lot of changes for the next couple months and even into 2026 in reaction to these federal law changes. The last bullet is about the potential for onshoring of manufacturing, not only because of the federal tax law changes, but also because of tariffs. And we want to make sure that everyone keeps in mind that states have a lot of lucrative benefits from a manufacturing perspective when you're onshoring jobs. So keep in mind that if you're going to increase headcount or develop a manufacturing facility or build out an existing facility, if there's going to be a lot of spend there and a lot of increase in headcount, we want to make sure that we get in front of that. We flush out the possibilities of state and local tax incentives relating to building out a facility or bringing jobs onshore. Moving on to the next slide. This is, again, something that Lucy's going to dig into a little bit more. And Mark mentioned about the qualified small business stock options and the changes at the federal level. Just wanted to mention that the states have their own provisions related to this. Many states conform to the federal rules on this. So you could have a favorable treatment at the federal level that trickles down and you get that same impact at the state level. However, there are select states that do not conform to these favorable federal provisions. I call two out here on the screen, California and Pennsylvania. They're big ones we see on a regular basis. There are a couple other states, might be Alabama and Mississippi. We don't see those quite as often. But the idea here is that if you do have a nonconformity state and you're a resident of that state of California or Pennsylvania or one of the others, there are thoughts that can go into possibly sidestepping this problem. It's not always that easy to change your residency, but you can consider a change in residency if you're foreseeing a sale of stock that would qualify for this favorable treatment. And New Jersey was on the list with California and Pennsylvania, but they recently changed their law and it's going to go into effect in 2026. So they will conform to the federal treatment. This next slide, we move away from the federal law a bit. And although it is a federal law, Public Law 86272, it just has nothing to do with the OBBBA changes. This is more of a call out in that states are trying to narrow this provision. It's a federal law that impacts state taxation. And what that federal law is it's very favorable for manufacturers and distributors in that a state cannot impose a net income tax on a business if that business's activities are limited to the solicitation of sales of tangible personal property and other ancillary or de minimis activities. So what that means is that you could be sending salespeople into a given state where they're trying to drum up sales. All they really do is try to create more sales in that state. If that's all that they're doing, the state cannot impose a net income tax, which is, again, it's very favorable. States, of course, don't like that. They're trying to narrow what qualifies as a protected activity. And the states, in their ultimate wisdom, or some of them at least, are saying, look, there are activities in this new world of, it's not a very new world, but this law was written in the 1950s, but we're looking at online activities. And could those online activities go beyond the mere solicitation of sales of tangible personal property? And the state's views are, yes, those activities could, such as we show on the screen, scenarios where you're putting cookies on customers' electronic tablets or computers, smartphones, where that information is used for something beyond soliciting sales, whether it's used for market development or product development, market research, inventory adjustments. That's something beyond the solicitation of sales. States are also looking at activities like post-sale assistance, where there's a chat function on a company's website, and that chat function can be used by a customer to get guidance on how to use a product, or if there are problems with the product. Certain states are saying that's going too far. You're no longer just soliciting sales of tangible personal property. The last bullet about online job postings, right? That has potentially nothing to do with sales functions. So that may also be going beyond solicitation of sales. There are a few states that have been very aggressive on this issue. Some have put regulations onto their books related to this narrowing of Public Law 86-272. New Jersey, New York, Massachusetts, California put out guidance on this that was invalidated by a court ruling. However, we understand that the state is still saying, like, look, this is a federal law, and our interpretation of that federal law is that these activities are going too far. So we want to make sure that we have a strong understanding of what activities are being done online and how that impacts any Public Law 86-272 positions that companies are taking. We think that there's going to be a continued pushback by the industry against these laws. So we'll see how things evolve over the course of the next couple of years, but we want to build awareness of this and what the potential risks are going to be. The bottom bullet is that there's a twist to this, right? There could be a benefit related to the narrowing of Public Law 86-272 in that certain companies will now be viewed as taxable in certain states. And the company's apportionment percentage could actually decrease in a high tax state, and thereby the overall tax liability for a company may decrease. This is a case in point where we want to look at the holistic impact of a change, where we're not just narrowly focusing on the bad stuff. There could be some good stuff, some sort of silver lining in these narrowing of benefits from a Public Law 86-272 perspective. Flipping over to sales and use tax, I'm sure most of you are aware of manufacturing equipment exemptions, right? States want to foster the purchases of equipment and the build out of manufacturing functions in states. So they provide for these exemptions for the purchases of manufacturing equipment. We want to do whatever we can to expand the exemption. So we really want to dig into the rules related to those exemptions and try to expand what qualifies as manufacturing equipment. That could be something along the lines of looking at when the manufacturing process begins and ends, and looking at whether a forklift could qualify, or a conveyor belt, or a racking system that pushes into, say, an oven or something that might heat and create a new product. So we want to keep looking at those definitions and try to jam in as many pieces of equipment as possible. The packaging exemptions, this is just really being mindful that when you purchase boxes and tape and anything that really goes into wrapping up your product and that product being sold to the purchaser, that could qualify for a packaging exemption. So you want to be looking at your purchase invoices on this side to make sure that your vendors are not applying sales tax to these purchases if they actually could be exempt. The third bullet is really on the flip side, where we see scenarios where manufacturers and distributors are making purchases of certain items that are not being subjected to sales tax by their vendors. And we see this a lot when there are purchases from overseas. Those vendors are usually not aware of or may not be required to collect US sales tax. However, the use of those products in the United States may be subject to sales tax and in turn use tax, where a company may have the requirement to directly submit tax to the state when the vendor does not charge sales tax. So we want to watch out for both sides of kind of the sales and use tax coin, right? The sales tax exemptions, we want to take advantage of them as much as possible. If there's an exposure, we want to identify that exposure, be aware of it, and think through the possibilities of covering off that exposure through what's called a voluntary disclosure program, or just at least being knowledgeable of it and just being aware of it and keeping it in your mind as to how to potentially address that in the future. The last bullet is simply about looking back at all of the analyses that we have done from a sales tax perspective over the course of about the last 7 years. There was a major sales tax law change in 2018 where there was a Supreme Court ruling that really changed the landscape from a sales tax perspective and in turn required many companies to start collecting sales tax across the country. There was a lot of work done. It kept me very busy for a few years where we were working with many of our clients to flush out these issues, to make sure that we're in compliance from a sales tax collection perspective. However, those things have kind of gotten backburnered, right? You got into compliance in 2020, 2021, and so on, but we haven't looked at that for a number of years. Let's dust that off. Let's make sure you're in compliance and move forward. The last slide for me is really kind of a hodgepodge grab bag of things that we see impacting the industry. The past serenity tax, I'm sure many of you are familiar with it. This was a workaround for the SALT deduction cap at the federal level. The idea was that states put in a regime where past serenity owners could now pay state tax at the entity level to work around the federal state tax deduction cap. And as you likely know, the OBBBA changed the cap for the SALT deduction. However, the past serenity tax continues. There's still an opportunity there if you are maxed out or you can't take advantage of the SALT deduction at the federal level, the past serenity tax still exists. So it's still a viable option for flow-through entity owners. Some states are trying to catch up on the law changes though, right? Illinois is an example where they need to change their law to keep it going. They have a bill that's outstanding. It likely will pass because it's taxpayer friendly, but it still hasn't. So 2026 from an Illinois perspective is up in the air. The next bullet is really about the continuation of remote work, right? During COVID, we saw a lot of companies' geographic footprint expand because many companies said, look, you can work from Texas, you can work from Washington State, you can work from wherever you want from home. We just want to make sure you're doing your work and taking care of business. That continues on, right? We've evolved where many of us work from home, and that can impact the nexus profile of a company. So we want to watch out for those impacts, whether it's on an expansion of your tax filing requirements, a narrowing of the Public Law 86-272 protection you may have had in place for years. We want that knowledge. So definitely take a look at it. The last bullet is about the increased enforcement actions that we're expecting at the state level. Many states are experiencing budget shortfalls, so we have an expectation that the states will increase audit activity, increase sending notices to taxpayers to make sure that they're complying with the laws. So we have to be ready for that. We want to shore the ship, make sure we have everything in place that we should, and that we can step around liabilities if the states come attack. That's it on my side. I'm going to pass it over to Bob.
Thanks, Eugene. Everybody, today I'm going to talk about R&D tax strategies, and we're going to focus on R&D expenses as well as the R&D credit. So I'll start with the R&D expensing. Prior to 2022, most taxpayers would expense R&D costs currently. And the rules changed with the Tax Cuts and Jobs Act back in 2017. And as of 2022, required taxpayers to capitalize and amortize R&D costs. And to the extent that those are domestic or U.S. R&D costs, they were required to be capitalized and amortized over 5 years. And if they were foreign R&D costs, they were required to be capitalized and amortized over 15 years. So from 2022 through 2024, many taxpayers were hurt by this by effectively increasing their income because they were getting less of a deduction due to the capitalization of the costs. Then fast forward to the OBBBA, there were a lot of changes in there related to R&D expensing. So the new section is called Section 174A, and that relates to domestic R&D expenses. So effective for tax years beginning after December 31st, 2024, all taxpayers can now expense domestic R&D expenses currently, okay? However, if the foreign R&D expenses continue to need to be capitalized and amortized over 15 years under the old Section 174. So there's no change to the foreign, but there's a very favorable change to the domestic. So this provides clients with an opportunity to accelerate deductions by deducting R&D costs, domestic R&D costs currently. And in addition, to the extent that companies are performing, a lot of their R&D activities outside the U.S. or using foreign contractors to perform R&D outside the U.S., they may want to consider bringing some of those jobs or contractors here to the U.S. Simply because of the 15-year amortization versus getting a current deduction. So some planning opportunities exist there. Another big change that was part of the Act allows all taxpayers that capitalized R&D expenses, domestic R&D expenses from 2022 through 2024 to write off or effectively amortize the remaining net unamortized balance as of January 1st, 2025. So, if you're a company that capitalized domestic R&D costs from 2022 through 2024, whatever that unamortized balance is as of the beginning of 2025 can be deducted in 2025. And that it's treated as amortization, which comes into play with some other tax planning ideas, 163J, et cetera. So again, it's another opportunity for taxpayers to accelerate deductions by getting this large deduction, amortization deduction in 2025. There are some special rules related to eligible small businesses as it relates to the R&D expensing rules. So if you're an eligible small business, and an eligible small business is defined as a taxpayer that has $31 million or less of average annual gross receipts from 2022 through 2024. If you're an eligible small business, then you have the opportunity to elect to retroactively apply these new rules, the rules under Section 174 Cap A. So if you were a taxpayer that capitalized R&D costs from 2022, in 2023. We're probably going to capitalize costs in 2024. You can now go back and either amend returns to deduct the cost currently, or file a method change with your 2024 return. So I'll walk through those two options. If you go down option one of filing amended returns, then what you would do is you basically amend each of the returns, include a election statement to each of those returns, basically declaring that you're electing to retroactively apply these rules, and then you would apply for the refunds. Those amended returns would need to be filed by July 6th of 2026, which is effectively 1 year from the date that the act was enacted, OBBBA was enacted. In addition to going back and amending the returns to deduct the R&D costs currently, the new law also allows taxpayers that claimed the gross R&D credit in those years, say 2022 through 2024, which many taxpayers did with these new capitalization requirements under the TCJA of 2017. Many taxpayers did claim the gross credit. The new rules allow these taxpayers to go back and elect to make a late 280C reduced credit election. So, there's some modeling that needs to be done there, but in some cases it could be favorable to go back and make that late 280C reduced credit election. The other option, filing a change in accounting method, requires less compliance because you don't have to amend returns. Instead, with the 2024 return, if you would file a Form 3115, change in method of accounting, that would basically look back to 2022 and 2023 and determine what we call a 481A adjustment, which is basically a true up that you would report in 2024 as well as the next 3 years. So it would be what's called an unfavorable or a positive 481A adjustment, because you're adding, it would be a favorable 481A adjustment. You would take the deduction in 2024. Go to the next slide. So a lot of these opportunities that we've discussed thus far relate to accelerating deductions, right? But in some cases, companies may not want to accelerate deductions for various reasons. It could be because maybe they're in a loss position, that operating loss position, and possibly they have 382 loss limitations that are applicable. So taxpayers do have the opportunity to either continue to amortize the previously capitalized costs, domestic R&D costs that were capitalized from 2022 through 2024, or they can file a change in method of accounting using what's called a statement in lieu of, to instead capitalize and amortize the R&D costs over 60 months, but you wouldn't start actually amortizing the R&D until you start generating benefits from the R&D expenses. So that's a way of really pushing it out there. And then there's also the old 59E, Section 59E, which allows you to capitalize and amortize R&D costs over 10 years. So again, there are various scenarios that you can look at depending on your particular situation, whether or not you want to accelerate deductions or possibly decelerate deductions. Now I'm going to jump over to the R&D tax credit. there really weren't a lot of change. There weren't really changes to the R&D tax credit, other than, as I mentioned earlier, the ability to make a late 280C election, or to revoke, or to make a to claim a late election to claim the gross credit. But some things to think about in terms of how the changes in the OBBBA new law can impact the R&D credit. So many taxpayers didn't claim the R&D credit from 2022 through 2024 because they were concerned about capitalizing R&D expenses, right? So if you claim the R&D credit, then you sure as heck should be claiming or capitalizing R&D expenses in those years, 2022 through 2024. And some taxpayers took the position that, what, we're not going to claim the R&D credit. We're really not doing R&D, and to not have to capitalize those R&D costs. In addition, I've seen other taxpayers that were conservative with their R&D credits from 2022 through 2024. So they still claimed the R&D credits, but they were more conservative, and this enabled them to minimize the Section 174 costs that were being capitalized. Beginning in 2025, obviously, as I discussed earlier, taxpayers are no longer required to capitalize domestic R&D costs. So we're back to the days of being able to generate an R&D credit and get the benefit of a current deduction for those R&D costs. So it may be advantageous for companies to revisit the R&D credit if they didn't claim the credit in those years, 22 through 2024. And it may be advantageous for them to just think about it prospectively. So some opportunities there for many M&D companies. Lastly, I just want to touch on, there's something that can really generate some immediate cash flow for small businesses, and it relates to the payroll tax credit. So if you're a qualified small business, which in short, you have to have less than $5 million of gross receipts in the current year, and there are some other rules about preceding tax years. But if you are a qualified small business and you generate R&D credits, you can elect to convert those R&D tax credits to payroll tax credits. So let's say if you're a taxpayer that's in a loss position and can't currently use the R&D tax credits, if you're a qualified small business, it may be advantageous to make the election to convert the R&D credits to payroll tax credits, which can be used to offset the employer portion of Social Security taxes, of your employee Social Security taxes. And many of our small businesses take advantage of that, and just wanted to point that out because there are some real cash tax savings opportunities there. That's it for the R&D section, and next I'll hand it over to Lucy.
Great, thank you, Bob. Hi, everyone. Thank you so much for joining this afternoon. I'm a partner here in the National Tax Group of Citrin Cooperman, and one of the things I get to do is lead what's called the Global Private Clients Services Group. And under the Global Private Client, we work very closely with entrepreneurs and other executives on tax planning that goes up the entire chain of ownership and maximizes opportunity. So in that light, a couple of things I want to talk to you about today. One is the qualified small business stock exception. A lot of you might have already heard about it, but I thought we'd break it down a little bit, especially how it looks after the new tax bill, and incorporating into that the state tax strategies. Tax is tax, right? No matter if you call it beautiful or ugly, it is still tax, so it's not always digestible. So I thought I would use an example to walk us through the qualified small business stock exception. And it's kind of loosely based on a real life example. In my 25-year career, one thing I got to do was to run a technology company. It was a technology company in the sustainable space. And so there were some really interesting planning opportunities that we took advantage of. But I wish we had more of it like we do now. In any event, let's get to it. So let me run through the background. So Pulp Fiction is an LLC that's 100% owned by one person, John. Pulp Fiction basically has its own technology, and it uses it to manufacture sustainable paper and pulp products. So your recyclable, compostable cups and other paper pulp products. By about middle of this year, Pulp Fiction has grown a lot, and it's got aggregate gross assets of about 55 million, right? So from nothing, it's grown to 55 million. But then there are a lot of new opportunities that Pulp Fiction wants to take advantage of. So Pulp Fiction's leadership team has made a decision that they would engage in some major expansions in the coming years, including building a new, larger manufacturing facility. We didn't get to talk about this, but as you might have heard about, we have the bonus depreciation. And within the bonus depreciation, there is a new provision for qualified production activity, which basically means if you build a factory within a certain time period and put it to use, you can claim a bonus depreciation for it. So Pulp Fiction might consider that. It's also considering acquiring advanced pulp processing equipment. Again, that could qualify for bonus depreciation. It's also going to do a lot more R&D, and Bob just ran you through the benefits of the R&D provisions under the new tax bill. And it also wants to expand the global distribution network. So lots of really good stuff that it wants to do. Now, it's projecting about $10 million cash need to do all of these great things. And they have identified a single family office, Family Apex Method, the FAM to be an investor. But FAM is like really tax savvy, and they really want the tax optimized strategy for their investment. A solution could be using the qualified small business stock exclusion. So what is this? QSBS. QSBS was essentially a benefit that Congress created to incentivize investments into U.S. companies, right? They really want to promote entrepreneurship. So they said, if you are an entrepreneur, you build a business and you keep building it and you exit, we're going to allow you to exclude a certain amount of the gain because we really want you to be entrepreneurial. So the qualified small business stock has been in existence for a couple of decades. It's changed over the course of time, but the basic fundamental requirements have always stayed the same. So there are basically 5 components to be a qualified small business stock. 1, the company must be a U.S. corporation. 2, it has to be that the stock that you want to use to qualify for this benefit must have been acquired at its original issuance directly from the corporation for money or for property or services. So you can't buy it. You have midway, you have to have it issued from the company. There's also a gross asset test, which basically means that you got to be a small business, right? That's the whole purpose of the congressional intent, is to incentivize small businesses, entrepreneurship. So they said, okay, so if you want to qualify for this exclusion, at the time of the issuance of the stock that you want to qualify for this exclusion, the aggregate tax basis of the company cannot be more than 50 million. Now that includes cash, and it also includes other properties. And for properties, the value or the adjusted tax basis is basically the fair market value at the time of the contribution. So as you can think about, valuation services is an important component. And also in this aggregate asset test, you have to also aggregate relationships that are parent subsidiaries. So more than 50% owned subsidiaries are also aggregated into this test. The 4th requirement is a holding period requirement. In order to qualify for the exclusion by selling qualified small business, you have to hold it for more than 5 years. And then the final requirement is that you have to be engaged in an active trader or business, right? Because again, congressional intent, they want to incentivize entrepreneurship. So during substantially all of the taxpayers' holding period, you have to, at least 80% of the company's assets have to be used in actively conducting a qualified trade or a business. Now, if you know something about tax, you'll know that the so substantially all is a concept that we see a lot in different sections of the code. And so the Congress the code and the regulations do not quite define what substantially all means with respect to the qualified small business stock. But think about it, 70% or more. I know some folks think about even 90%, but in any event, the point of this is that you're required to be engaged in active trader business for substantially all, not all. So that is an important planning opportunity as well. So what is a qualified trader business? We often in the tax world define terms in the negative, right? So a qualified trader business is everything other than these three things. One of those things is any trader business that's performing services in the field of health, law, engineering, accounting, etc. So Citron Cooperman can never qualify, which really sucks. And then another business that does not qualify is if the business relies on one person or a small group of people to be its principal asset. And the third is banking, insurance, financing, etc. So AXO, is really everything else. So, Pulp Fiction will qualify for it. Okay. So as I mentioned, QSBS has gone through some modifications, but right before the beautiful bill changes, qualified small business stock exclusion basically provided an up to 100% exclusion, but that was capped at 10 million. And so if you qualified your company as a QSBS, and you sold the stock and you met the holding period requirement as well. So after 5 years, you were essentially allowed to deduct 100% of the gain up to 10 million or 10 times basis. So there was that limit. There was a monetary limit on how much gain you could exclude. The beautiful bill actually in this context is really kind of good. It does expand on the benefits. So that $10 million cap that was pre-beautiful bill now is at 15 million. That means you can exclude up to 15 million of gain you realize on qualified small business stock. Other thing it did is in that whole aggregate gross assets where you have to be small. Congress now says, yeah, you have to be small, but maybe a little bit bigger. So now you're looking at not 50 million, but 75 million, which can really be advantageous because that's like a 50% jump, right? And then the 5-year holding period requirement has also been modified. So pre-beautiful bill, it was all or nothing, kind of, right? Because if you know something about tax, you'll know that we have the rule and we have the exception, 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 exception. Anyway, so under prior law, you have to hold it for 5 years or more than 5 years to benefit from the exclusion. But now under the new bill, you can hold it for 3 years and still qualify for 50% of the exclusion. So that will be 50% of 15 million. You hold it for 4 years, you get to exclude up to 75% of the 15 million. If you hold it for more than 5, you still get to exclude 100%. Now, I know I keep saying 15 million because that's just easy for me to explain. But again, the exclusion amount is either 15 million or 10 times the tax basis. So I do want you to keep that in mind. That's really important. So to quickly walk through an example, pre-beautiful bill, if an eligible shareholder had QSBS for 5 years, realized gain of 12 million, only the 10 million would be excluded, and he would recognize gain on the $2 million delta. Post beautiful bill, there's essentially no gain to be paid taxes on, right? So now, if the same shareholder holds it for more than 5 years and realizes gain of 12 million, all of the 12 million is not subject to tax. If he holds it for 4, 75%, up to 70% of the gain, and then for 3, 50%. That's a really big benefit. So let's apply this to Pulp Fiction. Okay, remember Pulp Fiction is an LLC, and I said you have to be a C corporation. So Pulp Fiction should consider converting from an LLC to a C corporation. Okay, that conversion is not a taxable event under Section 351. If you want to be impressive, you can go tell your tax advisor, hey, I want to do a Section 351, and then leverage that into QSBS. And so if you convert from an LLC corporation, no tax. What happens is that, so now you've got John and Pham, two shareholders. Okay. And remember, pre-investment from Pham, Pulp Fiction's worth $55 million. Under the old bill, it would have been out. It would not have been able to benefit because it's more than $50 million. But now with the $75 million cap or an increase, Pulp Fiction can take advantage of QSBS. It'll be really important to value the assets of Pulp Fiction. So again, valuation would be a really important component of the tax planning. By the way, Citron Cooperman does valuations. And if there's an excess asset, maybe John should consider getting rid of it. He might, divest of the assets. He might make a gift of some of those assets, for example. Pulp Fiction is engaged in a qualified trader business because it's not the accounting, legal, or healthcare. It's not relying on John's reputation. It's really the IP, right? And it's also not a banking financing thing. So now we qualify for QSBS. And if John and Pham hold the shares for 3 to 5 years and exit, they can each exclude 50 to 100% of the gain. For John, however, remember when he started, he contributed $55 million. He kind of rolled that over from the LLC to the C corporation. That part does not qualify for the QSBS, so he'll realize gain on that $55 million. But that means John now has a $55 million basis. So that means when John goes to sell Pulp Fiction, John can exclude 10 times his tax basis, That's $550 million of gain that he can exclude, which is really a lot, right? And so Pham can exclude up to $100 million because Pham is contributing $10 million of cash, so its basis is $10 million. So in this example, I really hope Pulp Fiction does really well. There's a lot of exclusion to be benefited from. Okay, so now there are some additional opportunities, right? So as I kind of alluded to, you can roll over QSBS. So it's not just from LLC to a C conversion, but you can go from a QSBS to a new QSBS, and you have to do that replacement within 60 days. We also use two other strategies. You might hear it, people talking about it. You pack the basis, you stack the benefit. Packing the basis just basically means like contribute assets, right? Increase the basis so you're not capped at the $15 million exclusion, but you get to do 10 times the cost basis like John and exclude up to $550 million. The last thing is stacking the benefit. That means that you are just creating more shareholders, in short. So you're stacking the benefit by creating additional people who can benefit from the exclusion. And I want to walk through a quick example on that of stacking the benefit. The 10 million or 15 million or 10 times the basis exclusion is on a per shareholder basis. So John and Pham both get to take advantage of it. Well, what if John said, wait a minute, okay, that's great, but I also want to, but I think my company is going to sell for more than that, maybe I'll sell for $1 billion, who knows? He can stack the benefit by gifting portion of his qualified small business stock to a family member or to a family trust, which is what we often see. And that gift would be made using the lifetime exclusion. So another beautiful thing about the new tax bill is that we now have the highest level of the estate and gift tax exemption than we've ever had in history. This year we thought was the highest at 13.9 million, but going into 2026, we have a floor of 15 million, and it'll continue to be adjusted for inflation. So from 2026, everybody will have, every US person will have 15 million of lifetime gifts to make, or you don't have to make lifetime gifts, you can save it and then it'll all go towards your state tax liability. But then you can take advantage of the QSBS stacking. So if John really wants to take advantage of it, he can give shares of QSBS, again, to family members using part of his lifetime estate and give tax exclusion. To further level, and that means then, for example, on an exit, John gets his exclusion, trust gets exclusion. So if you have multiple trusts, then everybody now gets that same exclusion. To further level up, John might consider consolidating his other non-business assets into a family limited partnership. We call it a flip because in tax world, we love acronyms and all these weird terms. So he can create a flip. He can gift assets into that flip, or transfer assets into that flip. Then he can gift interest in the flip to the same trust or to other family members. And when he's making a gift of that interest in the flip, the gifting is generally of a limited partner interest. And that limited partner interest is eligible for a discount because that limited partner, the LP interest, is only minority interest. It's a small, closely held family limited partnership, so it's not freely marketable. The LP generally cannot control anything anyway. So there are discounts, like even 30 to 40% of the value of the LP interest when you are making a gift of this interest. And that's important because that means that when you make the gift, you'll likely have to use part of your lifetime exemption. That means you get to discount the value that you're using of the exemption. So the LP interest, you can give 30% more than it is worth because you get to take a discount. Okay. To really supercharge it, you might also consider creating a family office for tax geeks. I talk about this a lot, and if you know me, you'll hear me talk about this a lot because I really love this strategy, especially for entrepreneurs and executives with complex holdings. I'm not going to spend a lot of time on this because I'll take up like another hour, but basically a family office for tax geeks is a tax optimization tool that consolidates your assets and creates an enterprise concept around it. So think about yourself as an enterprise, a business, right? What does it take to operate this enterprise? All those things that are required, like the travel, all the other things that you're doing, you can now consolidate into a management company, which we call the family office for tax geeks. And in so doing, you'll be able to claim deductions and expenses that you would not otherwise be able to do. And it also consolidates your assets and management of it, which can also help with governance. So I will stop there for now, but if anybody's interested, please reach out to me because it's a really fun and cool strategy. And I think now we're on to questions.
We are on to question. Thank you, Lucy. As Mark had alluded to in the opening, my name is John Giordano. I'm a co-practice leader of the Manufacturing Distribution Group here at Citron with Mark. So at this time, we want to open this session up to any questions that you may have. You could post through the Q&A box. While everybody's thinking of those, I do have a couple. Lucy, you're not getting off the hook that quickly. I think we're going to start with you because you have a couple come in already. In your presentation, there was a lot packed in there. So I'm not sure if you covered, but one of the questions I saw come through, I know you talked about going from an LLC to a C Corp, which is a non-taxable event. But what about in the event that it is an S corporation? So a subchapter S election for federal and state tax purposes, but they want to take advantage of the QBS.
So it's a really great question. It takes a little bit more work. It can be done, but there are additional things to consider. One, you would have to basically unelect your S status, and there's a time period requirement before you can do that without creating possibly a tax clawback. So you want to make sure that you understand the potential, sort of burdens on that, if you will. And so it's possible to do it, it just takes more time, and that takes a little more thoughtful analysis. One thing that I do want to, and this was not the question, but I do also get a lot of questions about what if I'm an LLC? Can I just make a tax election to be a corporation? Then do I have a C corporation? Because for tax purposes, I'm a C corporation. Yes, and there's actually a private letter ruling that addresses this specific fact pattern. And so that's also possible, but come talk to us so we can walk through the specifics of it.
Okay. And in that scenario of being a C Corp, there are some instances where you have international investors or foreign investors in that C Corp.
Yes.
So can you briefly kind of walk us through what that means in terms of this qualified small business deduction? Can the U.S. based stockholders still benefit? Can the foreign stockholders? So how does that kind of interplay?
Well, I love this question because am I not only a tax geek, but I'm an international tax geek. And so with respect to foreign investors, if you have a C corporation and the foreign investors are non-U.S. corporation or an individual or family office disposes of it, there's no U.S. tax because we do not tax capital gains of non-residents unless it's related to U.S. real estate. So for foreign investors, they're generally incentivized to invest into C corporation structures because when they exit, there's no tax to them. The additional, we did not talk about international provisions of the new tax bill, but in addition to all these domestic provisions, the bill also has a lot of changes to cross-border aspects of our corporate world. And so there are changes to what was once upon a time called GILTI. Now it has a new name. It's kind of like renaming your child, same concept, just a different name with some significant modifications. So there are other international provisions to consider, but for non-U.S. investors, capital gains is already exempt.
Okay, thank you. To stay on the topic of QSBS, but kind of transition a little bit to the state side of things. I don't know if Eugene's still hung around or if he can come up.
I'm here, Joe.
All right, perfect. So we talked about it from a federal perspective, but how does the qualified small business interplay into the state world of taxation? And if you're in a state that does not allow for it, can you reposition yourself to be a resident in a state that does?
Right. So most states do conform to the federal treatment. As I think I had on one of the slides, a couple states don't. California, Pennsylvania, there's a couple more beyond that. You can contemplate a residency change. That's not necessarily something that's done overnight, and it will require a lifestyle change, right? It's not simply getting an apartment in Nevada or Florida or Texas or something. We really have to contemplate all these domicile factors and so on. So we have to dig into it, but there's a possibility, especially if you have some runway there. If you're going to sell your company tomorrow, it's going to be really hard. But if you're planning on a sale within the next couple of years, we might be able to line that up if you're moving out of a state that does not follow the QSBS treatment.
Okay. Another state and local tax question. Some of our clients are often contemplating where to expand or where to open new warehouses or new leases of certain warehouses. And we're constantly hearing how there could be good credits and incentives out there.
Yeah.
Where is the best place for people to go to kind of consider those and what might be available to them?
Yeah, I mean, there really are opportunities across the country. So we try to have discussions where we're coupling the potential benefits from a tax perspective with the operational needs of the company. We often see benefits in the Southeast, whether it's North Carolina is a hot spot, Virginia, up in Massachusetts. It can depend upon the industry as well, but there are a lot of opportunities out there. I think once we start having those conversations, though, where the company may say, look, we can't put ourselves in Nebraska because there's not access to good employment. There's not access to channels of or ports So we really have to couple those business needs with the potential incentives, but they're certainly out there. I wouldn't necessarily pinpoint a specific state or two. It's have that conversation about the needs. We look at the possibilities on the state side and the local side, and we run from there.
Great. Thank you.
Sure.
Appreciate it. I want to thank everyone for attending today. We appreciate everyone's participation. Hopefully you found this insightful and useful. As we mentioned in the opening, our tax planning guide is up and live on the website. You can access it to read at your leisure. And thanks again for attending today.